What you're watching isn't a prediction. It's happening right now. China has officially rejected America's emergency bailout proposal, and COMEX, the world's largest metals exchange, is shutting down. The first major default of 2026 began at exactly 3:17 a.m. Eastern when Chinese officials confirmed they would no longer accept U.S. Treasury promises as payment. The emergency phone calls from Washington went straight to voicemail. Not a delay, not a negotiation. A complete rejection. COMEX officials are scrambling because their vaults can't deliver the metal they promised. This isn't market volatility, it's system failure. We've been tracking these warning signals for months. The sudden gold withdrawals, or the Treasury sell-offs, the emergency meetings. But this is the moment where theory becomes reality. The financial system you woke up with this morning won't be the same by sunset. If you want to understand exactly what happens next, hit subscribe now and turn on notifications. This story is moving by the hour. Your financial future depends on staying ahead of it. Like this video, if you're watching the most important economic shift of our lifetime unfold in real time, don't go anywhere. The evidence around China's rejection of the U.S. emergency deal and COMEX closure is just the beginning of what we're uncovering. The call came at midnight. Washington reached out to Beijing with an emergency proposal. The offer was simple: extend credit lines, delay bond redemptions, and keep the system breathing for 90 more days. Beijing did not answer. For 3 days, phones rang into silence. Emails went unreturned. Diplomatic back channels, usually busy with quiet deals, stayed empty. The silence was not normal, it was calculated. History shows us this pattern before. In 1971, when Nixon closed the gold window, foreign governments received no warning. The decision came fast, and the world changed overnight. This time, the roles reversed. America asked for help. China said nothing. The anomaly appeared in bond data. 3 weeks before the rejection, Chinese holdings of U.S. Treasuries dropped by $47 billion. This was not routine selling. The speed suggested preparation. Someone knew what was coming. Think of it like a chess game. When your opponent stops moving and starts watching the clock, they are not confused. They are waiting for you to run out of time. The open question remains, what triggered the final decision? Was it the failed gold delivery, the frozen SWIFT payments, or something we have not yet discovered? What we know is this: the rejection was not emotional, it was strategic. Beijing watched America's debt spiral for years. They held the paper, they tracked the failures, and when Washington finally called for rescue, China had already made its choice. The silence told the whole story. The emergency deal was dead before it started. COMEX is the world's largest gold and silver exchange. Every day, billions of dollars in metal contracts trade through its system. On the morning after China's rejection, something unprecedented happened. The exchange did not open. No announcement came first. Traders arrived at their screens and found frozen quotes. Phone lines to clearing desks rang busy. Within 2 hours, an official statement appeared: trading suspended until further notice. The last time a major metals exchange closed without warning was 1933. That year, President Roosevelt seized private gold and reset the entire monetary system. The closure was not a pause. It was a reset. The anomaly appeared in delivery requests. In the final week before shutdown, physical gold demand spiked 400% above normal levels. Clients were not rolling contracts forward. They wanted real metal in their hands. This is the financial equivalent of a bank run, except the bank held gold instead of cash. Picture a warehouse with a single door. Hundreds of people suddenly rush toward that door at once. The door cannot handle the pressure, so management locks it entirely. The open question troubles every analyst watching: where is the physical gold? COMEX vaults reported adequate inventory, but delivery failures began appearing weeks earlier. The numbers on paper did not match the metal in storage. This connects directly to Beijing's silence. Chinese buyers had been requesting physical delivery for months. When those deliveries failed, trust collapsed. The rejection of America's emergency deal and the COMEX closure happened within hours of each other. Coincidence does not explain timing this precise. America's debt did not become dangerous overnight. It grew slowly, year after year, like water rising behind a dam. For decades, the world ignored the rising level. China did not ignore it. They measured every inch. By 2024, U.S. national debt crossed $34 trillion. Interest payments alone consumed over $1 trillion annually. This was not theory. This was math. And math does not negotiate. The historical pattern is clear. Every empire that borrowed beyond its productive capacity eventually faced a choice: inflate the currency or default on obligations. Rome did it, Spain did it, Britain did it. America now faces the same mathematics. The anomaly appeared in interest rate behavior. Despite rising inflation, foreign buyers started demanding higher yields to hold American debt. This signals distrust. When lenders want more return, they are pricing in risk of non-payment. Think of debt like a credit card with no limit. The first few years feel free, then interest compounds. Soon, monthly payments eat your entire income. Now imagine the credit card company suddenly closes your account. You cannot borrow to pay old borrowing. The spiral stops violently. The unanswered question haunts Treasury officials. When did China decide that holding American debt was more dangerous than dumping it? The sales accelerated months before the rejection. Someone did the calculation and decided the losses from selling were smaller than the losses from staying. This connects directly to the COMEX closure. When your largest creditor loses faith, everything built on that credit starts shaking. The default was not political revenge, it was mathematical inevitability finally arriving. Gold does not disappear, it moves. For the past 7 years, physical gold has been flowing steadily from Western vaults to Eastern ones. London's gold stockpile dropped 40% since 2020. During the same period, Shanghai's vaults filled. This movement tells a story older than paper money. Throughout history, gold flows toward rising powers and away from declining ones. The Spanish Empire lost its gold to Britain. Britain later lost gold to America. Now Western gold moves east. The anomaly appeared 3 months before the COMEX closure. London's LBMA reported temporary delivery delays on large gold transfers. These delays stretched from days to weeks. In financial markets, delayed delivery means one thing: the seller cannot find what they promised to sell. Imagine a restaurant taking reservations for tables that don't exist. At first, they make excuses and delay seating. Eventually, they must admit they're overbooked. The gold market became overbooked. Too many paper claims existed for each physical ounce. The mystery that remains unsolved: who holds the actual metal? Vault records show ownership on paper, but paper claims and physical bars have disconnected. Major central banks have not allowed full audits of their gold reserves for decades. This connects directly to China's rejection of America's emergency proposal. Beijing requested physical gold as part of any continued financial cooperation. When delivery became impossible, negotiations collapsed. The COMEX closure simply confirmed what insiders already knew. The gold was gone. Not destroyed, just moved to new owners who would not sell it back at any price. When financial systems break, central banks respond. In the hours after China's rejection, an emergency coalition formed. The Federal Reserve, European Central Bank, Bank of England, Bank of Japan, and Swiss National Bank announced unlimited dollar swap lines to prevent collapse. This wasn't their first coordinated rescue. During the 2008 crisis, the same central banks pumped trillions into markets. That effort succeeded. This time it failed within 6 hours. The historical pattern reveals why. Every reserve currency in history survived crises until a critical mass of users lost faith simultaneously. The Spanish dollar, British pound, and now the US dollar all followed this path. The anomaly appeared in the currency markets themselves. Despite central banks offering unlimited dollars, the dollar index rose sharply instead of stabilizing. This counterintuitive movement signaled panic buying, not because people wanted dollars, but because trillions in dollar-denominated debts suddenly needed emergency repayment. Think of the dollar system like a giant game of musical chairs where players believed more chairs always appeared when needed. When the music stopped and no new chairs appeared, everyone scrambled for the few remaining seats. The question troubling economists: why did the intervention fail when the combined firepower of these institutions seemed unlimited? The answer connects to trust. Central banks can print currency, but they cannot print trust. Once confidence breaks, no amount of newly created money restores it. This links directly to the COMEX closure. Both events expose the same truth. Financial systems work until participants question their foundations. When China walked away, the questioning became impossible to contain. Financial crises spread like wildfires. The China rejection and COMEX closure created a chain reaction across 4 continents within 72 hours. Markets that seemed unrelated suddenly moved together, revealing hidden connections. First, derivative markets froze. Credit default swaps, insurance against bond failures, jumped 1,200% overnight. Trading desks stopped quoting prices. Without prices, the trillion-dollar derivatives market simply stopped working. Next, currency markets fractured. The Japanese yen, Brazilian real, and South African rand all moved more than 15% in a single day. European banks stopped exchanging certain currencies entirely. ATMs in 12 countries ran empty as people rushed to hold physical cash. The historical pattern matches the 1997 Asian financial crisis. Then, Thailand's currency collapse quickly infected Indonesia, Malaysia, South Korea, and the Philippines. What looked like separate economic systems turned out to share invisible links. The anomaly appeared in sovereign debt markets. Countries with strong financial positions saw bond yields spike alongside weaker nations. This uniform movement defied traditional risk assessment. Markets were no longer distinguishing between strong and weak borrowers. Everyone faced the same distrust. Imagine a power grid where one major station fails. At first, only nearby areas lose electricity. Then backup systems overload, and suddenly distant cities go dark. Financial contagion works the same way. Failure jumps between seemingly separate systems. The unanswered question: why did supposedly safe markets collapse as quickly as vulnerable ones? The traditional safe havens offered no protection. This connects directly to China's rejection. When the world's largest trading nation steps away from the financial system, no corner of that system remains truly isolated. While Western markets burned, a new financial system was already operating. China did not simply walk away from the old order. They had built its replacement. This alternative system had been under construction for over a decade, brick by brick, far from Western eyes. The clearest sign came 3 days after the COMEX closure. 27 countries participated in the first public settlement using the new Shanghai clearing mechanism. Trades in oil, gold, and agricultural products completed without using dollars, SWIFT, or Western institutions. History shows this pattern before. When the British pound collapsed as the world's reserve currency, the dollar system had already been architected at Bretton Woods. The replacement was ready before the old system failed. The anomaly appeared in gold pricing. While COMEX remained closed, Shanghai's gold exchange quoted prices 37% higher than London's last print. This gap revealed two separate worlds with two separate valuations, a financial divorce between East and West. Think of the global economy like an old house with new construction next door. The residents gradually moved their valuables to the new building while still sleeping in the old one. When the old house finally caught fire, they simply walked next door. The question that remains, how will Western nations function in this new system where they no longer write the rules? For 70 years, America enjoyed what Charles de Gaulle called exorbitant privilege from controlling the world's reserve currency. This connects everything we've examined. The debt spiral, gold movements, failed interventions, and market contagion all pointed to this moment, when an alternative system emerges and the unipolar financial world splits into competing centers. The transition has only just begun. The evidence now forms a complete picture. What appeared as separate events, China's rejection, COMEX closure, debt spiral, gold movement, failed interventions, market contagion, and the emergence of a new system, were actually connected pieces of a planned transition. This was not random. The timeline reveals careful sequencing. First, physical gold moved east for years. Then China reduced Treasury holdings. Next came delivery failures in metal markets. Finally, when Washington extended its hand for help, Beijing had already positioned itself to walk away. The patterns match every major currency transition in history. The Spanish piece of 8, Dutch guilder, British pound, and now the US dollar all followed similar paths, from dominance to displacement. What makes this transition different is its speed and the digital infrastructure enabling it. For ordinary people, the immediate effects will be painfully simple. Purchasing power will shift dramatically. Assets priced in dollars will reprice to reflect new realities. Access to global goods will change, based on which currency system your country joins. Think of the global economy as a train switching tracks. The train doesn't stop. It continues moving, but on a different path. The passengers feel only a slight bump during the switch, but they arrive at an entirely different destination. The warning signs were visible for years. Rising gold prices, de-dollarization announcements, alternative payment systems, central bank digital currency development, new commodity exchanges. These were not preparations for negotiation. They were preparations for replacement. What comes next is not the end of global trade, but its reformation under different rules, different centers of power, and different measurements of value. The world is not ending. It's reconfiguring.